All right, so we're going to go ahead and get started. The first topic of the day that I wanted to cover is actually hedge funds. Now, hedge funds are usually seen as the holy grail because the typical investor, they sort of have this mentality that wealthy people are invested in these hedge funds that are doing really great and they might be missing out. Unfortunately, that's not really the case. Hedge funds have had a lackluster year in 2011. It's been a tough year for everyone. There's no doubt about that. But hedge funds especially have been taking a hit, and the big issue here is that these are instruments that are supposed to perform in whatever market conditions are out there. They're supposed to be hedged, as the name implies, but even with these attributes, they're still experiencing a lot of pressure in these market conditions. So this is the article in Reuters. It says, deep cracks are starting to show in the love affair between hedge funds and their investors. After another year of paltry returns on expensive investments, leaves many cheated and close to bailing out. It says, an asset class once feted for its ability to make money in all markets is back under the spotlight after the average fund lost 4.4% in the first 11 months of the year. Data from hedge fund research shows. So what's going on is investors are putting their money in with these hedge fund managers and paying pretty high fees. These hedge funds charge fees. It could be 2% of assets under management annually and also up to a 20% performance fee. So whatever money the investors make, the hedge fund manager could receive 20% or 20 cents on the dollar. Fortunately, it doesn't work in reverse. So when the hedge fund loses money, the investors absorb 100% of those losses. So it's kind of uneven in that respect. So when people do lock their money in with a hedge fund manager, sometimes they're required to keep their money there for several months or years at a time before they can take it out of the fund. And if you needed to take your money out today, you may have to wait 30, 45 days or something like that. So investors have a reason to be concerned because they're choosing these investments. They want solid returns. They have limited liquidity in some cases. They're paying high fees, and they're not really getting the returns that they were looking for. This kind of goes to show that there's no free lunch. Every asset class does well in certain conditions and doesn't do well in others. And this kind of goes to show that the average Joe investor is not necessarily missing out. It says, I'm disappointed at the level of return, says one large institutional investor who asked not to be named. The hedge fund industry has once again been underwhelming people's expectations. It's an expensive asset class. They're going to have another 2001 and 2003 in the next 3 to 5 years if they expect the industry to grow. And these are not just the small hedge funds that are affected by these conditions. It's also the biggest. It says, star managers have suffered, notably John Paulson, whose main advantage fund was down 47% to the end of November. Again, no asset class is really immune from market conditions, no matter how much it'll tell you principal protected or it'll tell you it's hedged or this or that. There's always risk involved. So a hedge fund researcher at pensions consultant Aon Hewitt says, I think what you have seen is that the average fund out there is probably not a good investment, and that the main lesson is not that hedge funds that our clients are choosing are not performing, is that hedge funds as a whole aren't performing. He goes on to say that not only is this second down year in 4, but the up years have been in line with the market. So you've had 4 years that have been in line or horrific, which tells you everything you need to know. He goes on to say, in the new paradigm, they should be aiming for capital protection. They should be trying to minimize down capture and offer a decent amount of up capture. I do have a genuine worry for the industry. That's just a little bit about how hedge funds are doing this year. This article came out very recently, earlier this month. A different article from The Economist also mirrored this sentiment. It's a little earlier from this year. This came out in August. It says, hedge funds first disappointed investors en masse in 2008 when the average fund fell by 19%. Since then, they have struggled to beat the market. This year, performance has continued to be lackluster. The hedge fund industry needs to produce outsized returns for the rest of 2011 if it is to restore its reputation. Now, this actually has a good chart here, which shows that hedge funds can definitely be uncorrelated to the market, which in some cases is very good. But over here in about 2007, 2008, we see that the hedge funds took more of a dive than the S&P 500. So hedge fund investors actually experienced heavier losses. And then on the upside, they did not experience all of those upsides when the markets did go up to a higher level. So once again, it just shows that diversification is very important, and chasing returns is not always a great answer because you may end up on the wrong side of the market. This goes on to say that the effects will be felt most by some of the weakest funds, many of which need a quarter or two of good performance to restore the morale of their investors and traders. Should they continue to underwhelm in the coming months, investors are likely to withdraw their money. This could force some smaller funds to wind down. Now here's where it gets really interesting, because hedge funds have what are called high water marks. What this means is if a fund is, let's say, at 100 and it drops below that high water mark, the hedge fund manager, depending on the specific compensation model of that particular fund, they may not be able to collect performance fees until that fund is back up to and over 100. So this could be a problem, because when hedge funds are doing great, hedge fund managers do very well. Unfortunately, when the market turns against them and they're below the high water mark, then they're putting in the work, they're buying the research, they're putting in the hours, and they're paying their employees, but they're not getting those performance fees. So a person would assume that once a hedge fund manager goes below this high water mark, then the focus would be to do everything in their power to increase returns, to really get in there and make the most of the market and really help their clients out. But no, of course, because finance is a wonderful industry of very imaginative people, and they have found a way to get around that. And here's how they do it. This Economist article outlines this very well. It says, other funds will close before investors have a chance to desert them. Some funds have been hanging on since 2008, trying to claw their way back to their peaks or high water marks, at which point they can once again earn lucrative performance fees. As many as 89% of hedge funds may still be under their 2006 and 2007 high water marks in June. Given their high costs, most have been barely surviving on management fees from investors, which are typically 2% of assets. So what these funds do is, when they're under the high water mark and the managers feel that they will not be able to get back to a high enough point to make performance fees, quite simply they shut down the fund. That's what happens. So you may be invested in a hedge fund and you're waiting for that manager to get back up to a level where you have earned back your losses. But what they'll do is they'll shut down the fund and start a new fund where the high water mark will essentially be reset. So all those investors that lost money with the fund will won't get their money back, but will get what's left of their investment back. And these managers will start over. Clean slate. And this works especially well after a market downturn, because when the market goes down significantly, it tends to go back up. These hedge fund managers have a very, very convenient system whereby they can close the first one, open the second one at the bottom, and ride the wave, so to speak, back to the top. So that's something else they can do. On the other hand, they can start working for a different hedge fund where the high water mark is in a different place and the performance fees are really working for them. So this just goes to show again that no matter what asset class you're looking at, you just have to remain cautious and remain diversified above all.